Good morning, Francois.
Good morning.
Nice to see you again.
Nice to see you.
I guess this week is all about the Fed and the FOMC and potentially forward borrowing requirements for the US government. But there's lots of other interesting things going on at the moment, notably China.
Clearly.
Now, China, China, by any metric, is very, very cheap. Is buying Chinese stocks a no-brainer?
I would tend to disagree. I think that tactically you can make a move, but there is still a lot of uncertainties. At the end of the day, the good news of today was the fact that there is the liquidation of Evergrande. It's the biggest real estate problem, but there are still other problems in the system. That's the first part. The second part is that what is worrying me is the macroeconomic issue. You have a few developments lately that are telling you that the situation is not stable. They announced that they will reduce the reserve requirement ratio. It means that they need to inject liquidity in the system. There is a lack of confidence among not only investors, but among consumers, because real estate represents a lot of the wealth of many Chinese people. So there is big question. And then you have this question which we raised already, which is there really a risk of deflation in China? Which is very dangerous when you have such a level of debt, because there is one thing that debt is like, it's deflation. And so I think that maybe tactically you can justify the idea that there is an opportunity to buy some Chinese stocks. But nevertheless, medium term, I still think that you need to have a clearer picture about what the government intends to do to support the economic activity down the road.
Well, there have been rumors recently that the Chinese government was preparing measures to reflate the economy. Also, that they were going to be buying stocks. That was a couple of weeks ago. There's no sign of that yet. Could they, for instance, repeg the yuan?
I don't think that it will bring them anything. I don't think it would be the right move. I think that when it comes to intervening on market, be careful. But in the past, they have intervened on market. It have never supported a long-term trend recovery in equities. When a government is obliged to act on the market by, as they did lately, which is to cut the short possibilities first from individuals, second, and it was over the weekend for the institutional investors. Be careful. It means that there is something rotten in the system. So I wouldn't take necessarily the fact that the Chinese are intervening to stabilize the market as a clear sign that there is a recovery for the market looming.
Where are the dangers coming from? Is it all about property?
It's partially about property, but it's also about, 2 weeks ago, 10 days ago, they came out with these numbers concerning GDP growth, 5.2%. There is a lot of doubt about the validity of this number. You have a lot of people who are doubting that this number is real, because when people are observing things in China, they don't have the impression that the economy just grew at that level. So it's a very, very difficult situation. And to me, what is key is really for them to develop a macroeconomic background that is supportive for equities, and that will take time. And it's not an easy task for them because they already have a lot of debt, not only in the real estate, but the governments have also important debt. Remember that they came out a few weeks ago with the idea that the central government is going to borrow long term out of the budget, something like 130, if I remember well, 140 billion US dollar. It's the first time in history that they are trying to do that. And it tells you that the local government have no ability to spend right now. So there is a problem in the growth engine in China that needs to be mastered, and it will take time.
I'm doing the best I can here. There was a title on the Financial Times, I think it was, that said that the US government had asked the Chinese government for assistance against the Houthis. Wouldn't this be a massive positive for the market, for this kind of rapprochement between the US and China, especially at the moment?
Yes, it would be, but clearly this situation, you mentioned that we are in a week where you have the Fed, which is going to be very important. You mentioned China. You mentioned earnings, because this week we will have significant earnings. Don't forget that this week we have the big five that are going to reveal their earnings. It's a key point for the market, I think. You know, it's 10 trillion market capitalization that is going to reveal the EPS. What will it mean in terms of AI reality? What does it mean for the ability for those stocks which have performed very, very well in the last 3 months, in last year, and even in the last few days? So this is a key element. But also, with the story of duties, what happened during the weekend is a very dangerous situation. You know, the fact that American soldiers were killed in the northern part of Jordan, and that it is connected to this situation where Iran is playing with Iraq and the Houthis to go against the US. The US consider that it's the case. It's getting very dangerous. The geopolitical situation this week needs to be observed very, very carefully. You are right. It would be good if the Chinese could consider the proposal from the US and try to act on the Houthis, on Iran, to bring them to, I would say, de-escalate the situation in the region, because it's getting very, very tense.
Coming to American US earnings, are we reaching the situation where uh, the announcement of results that matches expectations is considered a miss now? Are we in that kind of territory?
You can only judge after. Usually this is something that you judge after the behavior. What you could consider is to say, okay, let's look it clearly. Those stocks gain huge amounts, 30% last year on average. Some of them went up 50, 70%. You had one great year. You had one quarter, which was amazing. You had lately, by the middle of January, a return of the bull market after a kind of stabilization phase, which was mainly connected to the Big Seven. So what does it tell you? It tells you that there is nearly no room for disappointment. You need to deliver. And again, put the things in perspective. We all know that tech stocks, they are long duration stocks, okay? Very sensitive to interest rates. So this week is going to be very important, because on the one side, you want to see the facts, there are earnings, but then you have the Fed. The Fed needs to maintain a message that satisfies the market. Because if suddenly they add volatility on the interest rates, those kind of long duration stocks are priced for perfection, and you could feed into volatility on the equity prices over the coming days and coming weeks. So the combination of those two factors, the fact that there are high expectation, the performance have been strong, and on the other side, the fact that the Fed is going to give the message that they want to deliver, is making this week a very important one to my point of view.
Coming to the US government borrowing requirement, how much do you think they need to borrow? Is that already in the market? Are the expectations matched?
They are nearly matched, because the story is about, if I remember well, it's more than 3 trillion that they need to borrow this year. So that's something that is quite significant. The market knows it, and they know that the borrowing are so huge for quite a few months, because we all know that the trajectory of the public finance in the US is not a good one, and they need to refinance. Then there is the question, what will happen with quantitative tightening? This is something that is looming for the coming quarters. You know that some member of the Fed are saying that the Fed, need to stop quantitative tightening. They need to taper. So this will have an impact on the US borrowing needs over the coming quarters.
Do you think we could have an announcement on QT in the FOMC?
It could be. I think that maybe it could be a good, I would say, by March, it would maybe be a good, I would say, fair decision, which is to say, okay, by March, we don't lower interest rates, but we reduce the quantitative tightening. And so progressively, we reduce the risk that suddenly we face a problem of liquidity in the system. And I think it's possible that it could be a good measure for the Fed to consider a reduction in the quantitative tightening by March for the second quarter of this year.
I don't think anyone's expecting rate reductions on Wednesday. You confirm that, right?
Yes, 3%. I think that the expectation, but what is interesting is despite the fact that you have some messages from the members of the Fed over the last few weeks, we went from nearly 100% chance of a rate cut in March. We are still at 50%. So it still means that there is a disconnect between market perception and the message the Fed is trying to convey. And look again at the numbers. The numbers were quite strong over the last 2 weeks. There is still growth in the US economy. It's decelerating, but not. There is no threat of deflation of a recession in the short term. And that's the reason why, for example, Friday is going to be a very important day because we will have the non-farm payrolls. Non-farm payrolls, unemployment, wage growth remain the key factors for the Fed to observe because this is what is going to tell them if there is really a chance that the deceleration in the economic activity is going too far.
Is there any question that I should have asked you that I haven't? What's on your mind at the moment?
What's on my mind, I must say, when I woke up this morning, the story about the UTs, the reaction of the Biden administration, the fact that you have some Republican pushing from strong reaction from the US, I think that the geopolitical situation is worrying me. And the market consequence is what you observe in terms of oil prices. Oil prices has risen significantly. And this is something that central bankers are very aware. It's this situation in the Red Sea is a situation that is dangerous. It's a situation that can have negative impact on economic activity, negative impact on inflation, which means that the central banks are in a position which is very difficult. And don't forget that most of the equity rally, not most, but some of the equity rally that we have in the course of the last 6 months is connected to the fact that investors consider that central bank interest rate cuts are done deal. If that does not materialize, it's a big issue. People have jumped. They have jumped into the idea that 2024 will be the end of a decelerating cycle, and the second part should see the entering into a new cycle. This is, if you want, what people have in mind. That's a strong hypothesis. And what is happening in the Middle East is something that can impede the development or make this new cycle more difficult to build.
Francois, I think that's all we got time for. So I'd like to say merci beaucoup
De
and
rien.
speak to you next week.
Speak to you next
Bye.
week. Bye bye.
Bye-bye.